The Tulip Mania 1637. In the 1630s, the Dutch went completely insane over flowers. Tulips had just arrived in Europe from the Ottoman Empire, and the Dutch decided they were the most valuable things on earth. Rare bulbs with striped or multicolored petals sold for more than a skilled worker earned in a year. People sold their houses, their land, and their life savings to buy tulip bulbs they planned to resell for more. Futures contracts appeared, meaning people were buying tulips that didn't even exist yet, just promises of future flowers. At the peak, a single Semper Augustus bulb sold for roughly the price of a canal house in Amsterdam. Then in February 1637, buyers stopped showing up to auctions. Nobody knows exactly why. One bad auction, then another, then panic. Prices collapsed by 99% in weeks. The strange part is the Dutch economy didn't actually collapse with it. Most of the damage was personal. Ordinary people who had borrowed money to speculate lost everything. The lesson was there from the very beginning. When the thing being sold is just a story about future value, the story can end without warning. The Wall Street Crash, 1929. Through the 1920s, Americans believed the stock market only went up. Ordinary people, factory workers, teachers, and shopkeepers borrowed money from brokers to buy stocks, putting down as little as 10% of the actual cost. This was called buying on margin. If prices rose, you kept the profit. If prices fell, the broker demanded the full amount immediately. On October 24, 1929, called Black Thursday, panic selling started. Prices dropped, margin calls went out, people had to sell stocks to cover their loans, which pushed prices lower, which triggered more margin calls. Within days, $30 billion in market value was gone. Banks that had invested depositor money in stocks failed. People lined up to withdraw their savings and found nothing left. By 1932, the market had lost nearly 90% of its value. Unemployment hit 25%. The Great Depression lasted a decade. The core problem was simple. The whole system was built on borrowed money and the assumption that prices would never fall. When they did, the debt didn't disappear. It just became impossible to pay. Congress passed the Glass-Steagall Act in 1933 to separate regular banks from investment banks. It worked for decades until it was repealed in 1999. The Panic of 1837. Andrew Jackson hated banks. He especially hated the Second Bank of the United States, which he believed gave too much power to wealthy Eastern elites. In 1836, he killed it. He also issued the Specie Circular, an executive order requiring that land purchased from the government be paid in gold or silver, not paper money. This hit the economy like a brick. Banks across the country had been issuing paper money far beyond what their gold reserves could actually back. When people suddenly needed real gold to buy land, they rushed to banks to convert their paper. Banks didn't have enough gold. They started failing. By May 1837, almost every bank in the United States had suspended payments. Credit froze. Businesses closed. Unemployment in cities like New York reached 25%. The cotton market collapsed, crushing the Southern economy. The Depression lasted roughly 6 years. Jackson left office before the crisis fully hit. His successor, Martin Van Buren, inherited it entirely and was widely blamed. The core lesson is one that keeps repeating. When money isn't backed by anything real and credit expands too fast, the correction is brutal and it lands hardest on ordinary people who had no say in creating the problem. Black Monday, 1987. On October 19, 1987, the Dow Jones Industrial Average fell 22.6% in a single day. Still, the largest single-day percentage drop in stock market history. No war, no banking collapse, no obvious economic catastrophe. Just one day of pure freefall. The main cause was a new automated trading strategy called portfolio insurance. Fund managers had programmed computers to automatically sell stocks at prices dropped past a certain point, protecting against losses. Sounds reasonable. The problem was that when prices started falling that morning, thousands of computers all triggered at once, all selling simultaneously, which pushed prices lower, which triggered more automatic selling. The machine fed itself. Human traders tried to intervene and couldn't. The Hong Kong market closed entirely. London and Australia crashed alongside New York. The Federal Reserve stepped in immediately, pumping money into the banking system and encouraging banks to keep lending. Markets recovered relatively quickly compared to 1929. Within 2 years, the Dow had returned to pre-crash levels. After Black Monday, stock exchanges installed circuit breakers, automatic pauses that kick in when prices fall too fast, giving humans time to think before machines make everything worse. The tools now exist to slow the next one down. The dot-com crash, 2000. In the late 1990s, the internet was real, but the money was not. Investors poured billions into websites with no customers, no revenue, and no plan for ever making a profit. Companies raised enormous sums just by adding .com to their names. Pets.com spent $11 million on a Super Bowl ad before it had meaningful sales. Webvan tried to deliver groceries nationally before building anything that worked locally. The Nasdaq index rose 400% between 1995 and 2000. Then in March 2000, it peaked and started falling. When it became clear these companies were burning cash with no path to profit, the selling started. The Nasdaq fell 78% over the next 2 years. $5 trillion in market value was erased. Hundreds of companies went bankrupt. Employees who had taken stock options instead of salary lost everything. The real economy took a hit, but survived. What collapsed was the fiction. The actual internet turned out to be more important than anyone imagined, just not in the way investors had priced it. Amazon lost 90% of its value and came back. Google launched in the wreckage and thrived. The companies that survived were the ones with something real underneath the story. The panic of 1907, the entire American banking system nearly collapsed, and one private citizen stopped it. His name was J.P. Morgan. The trouble started when two speculators tried to corner the copper market and failed completely. Their bank, the Knickerbocker Trust, was connected to the scheme. Rumors spread, people lined up to pull their money out, the bank failed. Then panic spread to other banks. Trust companies across New York started collapsing like dominoes. The stock market fell nearly 50% from its peak. At the time, the United States had no central bank and no federal deposit insurance. There was nothing to stop a run. Morgan, then 70 years old, gathered the most powerful bankers in New York in his private library, locked the doors, and refused to let anyone leave until they agreed to pool their money and bail out the failing institutions. It worked. The panic stopped. But the whole episode made clear that a country of 90 million people couldn't depend on one old man to save its economy. Congress created the Federal Reserve System in 1913 directly because of 1907, a permanent lender of last resort so the next panic would have somewhere to go. The Great Recession of 2008. For most of the 2000s, American banks gave mortgages to people who couldn't afford them, then bundled those mortgages into complex financial products and sold them to investors worldwide as safe assets. Rating agencies gave these bundles top safety grades without understanding what was inside. When housing prices stopped rising and borrowers started defaulting, the bundles collapsed in value. Nobody knew which banks were holding the worst ones. Credit froze. Bear Stearns collapsed in March 2008. Lehman Brothers, one of the oldest investment banks in America, filed for bankruptcy in September 2008. The stock market lost half its value. 8 million Americans lost their jobs. 6 million lost their homes. The global economy contracted for the first time since World War II. The U.S. government spent $700 billion to bail out the financial system. Not the homeowners, the banks. The fundamental problem was that the people making the loans had no risk if the loans went bad. They just sold them and moved on. When everyone in the chain profits from making the sale and nobody suffers if it fails, the system builds toward disaster the entire time. The Dodd-Frank Act passed in 2010 to tighten regulation. Much of it was rolled back by 2018. The COVID crash in 2020. On February 20th, 2020, the stock market started falling. By March 23rd, the Dow had lost 34% of its value in 33 days. The fastest crash from a market peak to a bear market in recorded history. The cause was a virus nobody had a treatment for, shutting down the global economy simultaneously. Airlines grounded, hotels emptied, restaurants closed, oil prices went negative for the first time ever, meaning sellers were literally paying buyers to take barrels because there was nowhere to store them. The Federal Reserve cut interest rates to near zero within days and began buying assets on a scale never seen before. Congress passed a $2 trillion relief package in 2 weeks. The speed of the government response was unlike anything in previous crashes. Markets bottomed on March 23rd and then did something almost nobody predicted. They went straight back up. By August, the S&P 500 had fully recovered. By the end of 2020, it was at record highs. The real economy hadn't recovered. Millions were still unemployed. Small businesses were still closed. But cheap money and government support flooded into financial markets. The crash lasted 5 weeks. The questions it raised about who markets actually serve are still unanswered.